We talked last week about the problem facing Hong Kong, the dollar squeeze that was crystal clear in the HKMA's data. You can see it in HIBOR, the Hong Kong Interbank Offering Rate, that there was a liquidity squeeze. And that is really what brought the two parties to the table to extend out a truce. So both sides got a bit of what they wanted. China mainly gets its dollar flows back, and the U.S. Exceeded some important concessions as well for its own priorities. But the key thing here in from the capital war standpoint is if you look at the interest rates and money markets, and these differentials matter, right? You're on a global dollar standard, and if you don't have enough dollars within your own money center or your own regional, financial base, think about these in terms of blocks. You've got the U.S. obviously, which is the core. It is the domestic economy. That's where the dollar lives from the sovereign standpoint. But offshore, you've got Europe, you've got Southeast Asia, and you got the Caribbean for all the wealthy, business deals that take place, that type of stuff. But in Southeast Asia, the center, the financial center, you've got a lot of them that are important, but the most important one for Chinese trade, uh, the export industry, it's through Hong Kong. That's how China interacts with the dollar system. Is really, it starts in Hong Kong. You look at these interest rate differentials. I've got the 3-month HIBOR rate, and then I've got the 3-month T-bill in yellow. And you can literally see when one money center is trying to attract more dollars in, right? Why do you need more dollars? Well, everybody has a lot of dollar denominated debt outstanding, and you've just got to keep the machine humming along, right? When the debt service comes due, you have to make sure there are enough dollars within your financial system for your private sector industry and your governments to to service their debts so that they don't default on their obligations and liabilities. So if there's a squeeze for a money center, if it's able to attract dollars in, if your financial system is in a condition of health and you can raise rates to attract more dollar deposits into your, you know, regional hub, you'll do it. And this is what we saw in 2022 and 2023. The Fed said, okay, they saw inflation starting to get out of control. They were behind the eight ball, but they started to let rates rise. This is what the bond market was telling them they needed to do. They started hiking rates aggressively. Well, you see, what does Hong Kong do to keep its dollars from walking out, right? It's like letting your horses out of the barn, right? Well, you have to, because this is, a globally open capital system on the legacy dollar standard, you have to match, right? Otherwise, all of the horses are just going to walk across the open pen and over where the conditions look more attractive with higher yields, right? And so you see this going into late 2022 when the U.S. is showing, hey, we're really um, aggressively letting rates go up, right, off of that zero lower bound in 2020, 2021, the post-COVID environment, and you actually see Hong Kong, they raise rates further and above the Fed or the 3-month T-bill, right? They were really trying to, out hawk the hawks and say, no, 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 we're going to keep our dollars here. Well, then what starts to happen after that, right? As the pace of rate increases starts to slow down, um, you see HIBOR actually go negative against the T-bill, or equivalently, you see a positive spread of the U.S. Treasury bills, and which are really the think about it as the domestic economy onshore, short-term policy rates, where those can go. And you start to see from basically the beginning of 2023 on, the Fed and the US financial system and the Treasury are able to keep the front end in the US high, which is attracting, all else equal, dollars in from the rest of the global economy, other money centers, all of these financial institutions. And that effect is really, whereas if you're in a major growth uptrend, you're seeing US importing goods, people are feeling good, the consumer's healthy, they're going out, they're buying the things that go in shipping containers and come into Walmart. They keep doing that, but as that slows down, that rate differential, that whole time that slowdown is happening in terms of, the consumer, dollars are sucking into the US underlying this process. And then now it goes back to the Fed meeting of last week. 3 days before that, we saw the Monday before the Fed meeting on Wednesday last week, we saw IBOR collapse, a liquidity squeeze within Hong Kong. Essentially, it's saying they're low on dollars. They needed that. They needed the faucet turned back on, and the Fed, even in the face of this, is able to keep short-term interest rates high. So that's the effect. You're getting dollars coming into the United States. Now, on top of that, the consensus is we're going to get more rate cuts this year from the U.S. standpoint. So eventually, we're going to let off the gas. But right now, you're seeing, multiple things kind of working against each other to see how this ultimately plays out. And a key effect on this is what is going to happen to price levels in the economy.